My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, we are going to discuss an overview of liabilities. So the first thing is, what are liabilities? Well, liabilities are present obligations that entail the settlement by probable future transfer of cash, goods, or services resulting from past transactions. Now, that's the sort of official U.S. GAAP definition of a liability. In essence, though, a liability is an obligation that's payable to individuals or organizations outside of our business, to non-owners of the business. And we see liabilities, and you are familiar with all kinds of liabilities in our own personal lives, and we'll see a variety of liabilities here in financial accounting and reporting too. The valuation of transactions, the valuation of liability transactions, are guided by FASB accounting standards 410, 420, and 450. That's for U.S. GAAP. International Financial Reporting Standards also has guidelines for accounting for liabilities, and that is in IAS number 37. We will be discussing those in a little bit more detail later on. Also related to the issue of liabilities is the classification of liabilities. We know that the basic balance sheet is assets equals liabilities plus shareholders' equity. And when we go to prepare a balance sheet, we generally have to separate current liabilities from non-current or long-term liabilities. And current liabilities are obligations that are expected to be satisfied within 1 year or one operating cycle, whichever is longer. In most cases, that means that current liabilities are going to be satisfied by the consumption or use of current assets. Let's talk about the common types of liabilities. Accounts payable, notes payable, dividends payable, those are all examples of liabilities. Accounts payable are simply open accounts when we buy goods and services from a vendor and we don't pay for them immediately. A lot of times that will be recorded as an account payable. It's just simply an open or a trade account payable. Notes payable, a little bit more formal representation of an obligation where we actually sign a piece of paper that says we owe some dollar amount to somebody. Dividends payable results when the board of directors votes for the distribution of dividends, and there's a time lapse between when that vote is taken and when the dividends are actually distributed. Other types of liabilities that we would commonly expect to see on a balance sheet: sales taxes payable, payroll-related liabilities like FICA withholding and income tax withholding and so on, that we withhold from our employees' paychecks and then subsequently turn around and remit those to the relevant government authorities. Unearned revenues would be another example of a common type of liability. Unearned revenues is somewhat unusual or somewhat different from the other types of payables that we have. Accounts payable, notes payable, dividends payable, those sorts of liabilities and obligations we generally expect to satisfy by the distribution of cash. Accounts payable, for example, we buy goods and services on account and we agree to pay for those at some point in the near future, typically within 30 days. Unearned revenues is a liability, but is a little bit different in that unearned revenues is the result of collecting cash in advance of providing goods or services to a customer. A common type of unearned revenue, for example, would be in the airline industry. When you book a ticket, you pay for that ticket immediately, even though it may be 30, 60, 90 days before you are going to take your flight. Well, from the airline's perspective, they've collected the cash in advance of providing the goods and services. That is not yet revenue. That is what's known as unearned revenue, and unearned revenue is a liability. They have an obligation to satisfy the terms of the transaction, which would typically be flying you from point A to point B. When you buy a ticket, you don't expect to get a cash refund. What you expect is the airline to make good on their promise to fly you and your baggage from Atlanta to St. Louis or wherever it is that you happen to be going. So unearned revenues is another example of a liability, though it's typically not satisfied by the use of cash. Other types of liabilities: mortgages payable, bonds payable, lease liabilities, contingencies, asset retirement obligations, pension obligations. There are lots of different kinds of liabilities and obligations that we can see on a balance sheet. We will be talking about in future videos, we'll be talking about all the details with regard to how to account for, example, for bonds payable and lease obligations and contingencies and so on. I just wanted to get sort of a list of the common types of liabilities that you can expect to see on a balance sheet. All of these liabilities share the same set of characteristics. They are present obligations that entail the probable future transfer of cash, goods, or services resulting from past transactions. I also have these liabilities more or less organized by current versus non-current liabilities. In the left-hand column are the liabilities that we would typically expect to see listed as current liabilities. Those liabilities that we expect to satisfy within 1 year of the balance sheet date. So accounts payable, notes payable, dividends, and so on. Typically, we would expect to see those satisfied within 1 year of the balance sheet date. Mortgage payable, bonds, contingencies, lease liabilities, pension obligations, and such, those are more commonly going to be found in the non-current or the long-term portion of the liability section of the balance sheet. Those are obligations that we expect to be satisfied more than 1 year from the balance sheet date or over time. Common analytical tools that we use to evaluate the impact of liabilities. There are two ratios that we would typically expect to see. One is the current ratio, which is defined as current assets divided by current liabilities. And that's simply a measure of the firm's ability to satisfy their current liabilities by the use of current assets. In the case of a current ratio, the higher the number, the better, by and large. Normally we would expect a current ratio to be more than 1-to-1. In other words, we would expect to have current assets in excess of current liabilities. That doesn't always happen, but that's typically what we would expect to see. If you were to look at some financial statements, you would see current ratios ranging from maybe 0.75 or 0.8 all the way up to 2 or 3 or even 4-to-1, depending on the nature of the entity. But the current ratio is, again, just a measure of the ability of the enterprise to maintain payments and satisfy their current liabilities through the use of current assets. Another common analytical tool that we would use to evaluate the impact of liabilities is the debt-to-asset ratio. Total liabilities divided by total assets. Remember that the accounting equation, assets equals liabilities plus shareholders' equity. So some portion of our assets are financed through debt or liabilities, and some portion of our assets are financed through equity. The debt-to-asset ratio is just simply a measure of that relationship. What proportion of our assets are being financed through liabilities or through debt? And so you might have, say, $40,000 of liabilities and $100,000 of assets. That would be a 40% debt-to-asset ratio. So the debt-to-asset ratio is typically presented in percentage form, whereas the current ratio is typically in a ratio form, such as 0.75 to 1 or 2.4 to 1 or something like that. Both of those measures help us evaluate the impact and utilization of liabilities with respect to a particular entity. Notice that the debt-to-asset ratio is sort of an overall measure of liabilities, total liabilities, in relationship to total assets, whereas the current ratio focuses specifically on the current liabilities of the enterprise in relationship to the current assets. So that is a very quick, brief overview of liabilities. You have a definition. We have a little bit in terms of the standards, both US GAAP and IFRS standards that relate to the valuation and measurement and disclosure of liabilities. We have a little bit in terms of the classification of current and non-current liabilities on the balance sheet. And then we have some an overview of the examples of common types of liabilities that we'll expect to see on balance sheets. Subsequent video presentations are going to discuss in much greater detail how to measure, recognize, disclose, and analyze these types of liabilities. And then finally, we have a couple of analytical tools that we can use to help us evaluate the impact of liabilities on a balance sheet.